Jerome Powell just came out and said the Fed is going to start reducing the interest rate hikes. And Elon Musk said that the Fed has to pivot immediately, while the indicator that Jeff Gundlach uses to determine what the Fed will do next is showing they're only going to raise interest rates one more time. So this has investors saying the bear market is over, which leads us to the question, is it time to buy stocks? My quick answer, absolutely not. And I'm going to explain why in one simple, fast step. Let's get right into the fact that most people don't understand. The Fed pivot does not equal stocks skyrocketing. In fact, if we look at history, it equals a stock market collapse. Let's look at this chart going all the way back to the 1970s to today's date. On the left, we go from 100 all the way up to 4,800. Obviously a log chart of the S&P 500. Every single red arrow indicates when the Fed pivoted. And you can see starting right here with our first decline, the Fed pivots and then the market goes down 36% after the Fed pivots. Down 48%, 27%, 51%. The GFC, we had down 58% after the Fed pivoted. And just recently, during the cerveza sickness, or just prior to that, in 2019, we had the market down going into March of 2020, 35%. So we have to ask the question, what will happen now when the Fed pivots? But before we try to answer what will happen next, or maybe a better question, if history is any indicator, is how much will the market go down by? Let's go ahead and look at when Jerome Powell might pivot. Editor, go ahead and help me out with this one. We're going to throw up an animation. And what we can see right now is the inversion in the yield curve starts between the 1 year and the 2 year. But we can gradually see this moving closer and closer to the front end of the curve. In fact, right now, the 6-month Treasury yield is very close to the 1 year Treasury yield. I think this will invert soon. So as you see the inversion point moving closer and closer to the front end of the curve, this is the bond market telling us the Fed pivot is very, very near. So as smart investors, you need to pay attention to when that inversion point goes from the 1 year to the 2 year, 6 month to the 1 year, 3 month to the 6 month, and then all the way over to where the 1 month T-bill is trading under the Fed funds rate. Next, we have to think about how high the Fed is going to be able to raise interest rates before they start to pivot. To understand this better, editor, let's cut right to a clip from Jeff Gundlach himself.
Well, the Fed follows the 2-year Treasury, and I've been saying this for years and years. I don't know if your viewers can see this chart here, but it's a chart of the Fed funds rate in red and the 2-year Treasury in blue.
So the key here is to look at what the 2-year Treasury has been doing lately. If we go ahead and throw up a chart, we can see that it's pretty much flatlined around 4.3, maybe 4.4%. So this is the bond market telling us that the Fed is most likely only going to raise rates one more time. In other words, they're going to hit the pause button moving into 2023, and the first move that we see out of the Fed in the new year won't be an interest rate hike, but an interest rate cut. So right about now, I'm sure your friend and family member Fred is poking you in the side, and that's the proxy for all your friends and family members that think you are absolutely out of your mind because they think the mainstream media always tells them the truth. And the mainstream media is saying, buy the dip, buy the dip. Or you got Jim Cramer saying, buy, 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 buy. And you've got a lot of my fellow YouTubers saying, listen, the recession is canceled. It's over. So you've got to go out there and load up on index funds like any prudent investor would. Well, we go back to this chart, what we discussed earlier, and I would tell your friend and family member, Fred, that listen, buddy, most of the crash happens after the Fed pivots. And their rebuttal would be, yeah, George, but we're going to have a soft landing. Inflation is coming down from 8.2 to 7.7, and it's just gradually going to come down. It's going to float down with a butterfly like sore feet and land perfectly at the Fed's target of 2%. And then the Fed is going to pivot into this magnificent economy, and the stock market is going to rip higher. So get on board or else have fun staying poor. And to be fair, this is exactly how it could play out. At the end of the day, this is just a game of probabilities. There are no certainties. But I would argue a more likely scenario is we have a hard landing. See, right now, the mainstream media would lead you to believe that the only reason the Fed would lower rates is because of this soft landing scenario, because they've done such a fabulous job. But I think the more likely scenario is they actually pivot as a result of the United States economy going into a severe recession, if not economic depression, for several reasons that I have stated in prior videos, most notably the bullwhip effect that Michael Burry always talks about. We know that Amazon, as an example, has doubled their workforce just since 2020. They're starting to lay people off now. They just laid off 10 or 11,000 people. But over the last 2 years, they added 800,000 employees as a result of all the stimulus checks that went out. Bottom line, the government distortions. And these government distortions, although they did give a short-term sugar rush to the economy, now that sugar rush is turning into an anesthesia. So if their demand goes back to where it was in 2020, they'll most likely have to lay off 800,000 people, not just 10,000 people. And we see this same dynamic happening, not just with Amazon, but throughout the entire economy. And this is why I would say the probabilities, again, no certainties, of a hard landing is about 80% compared to maybe 20%. So if I'm a prudent investor, I'm going to position my portfolio around the scenario which has the greatest likelihood of coming to fruition. And I think this chart is what I would use as my guidepost. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.